Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch, and I'm here today with Tom Bacharach of RMC Group. But if you hadn't had the opportunity, you can go back and find part one of our conversation where we talked about retirement plans, retirement planning, as it was represented in the sort of the past, the present, and then ultimately the future. So Tom, I want to ask you just a quick question. Well, you know me, I don't ask questions quickly, but I'm going to go ahead and do my best to try to ask this as quick as possible. We often refer to here, at Ameritas Advanced Planning, of something as it relates to small business owners called the retirement gap, and that's that. We describe it as that gap that's created when you have a business owner that maybe has a 401k or some type of defined contribution plan, and they say they want to they have income that they're looking to replace in retirement, and their ability to use those defined contribution plans, the 401k, 403b for people who may not be, understand what defined contribution is. They don't have the ability to use those to replace that income, and we call that the retirement gap. Can you help us? Can you help sort of fill in the gaps there, or pardon the pun, right? Fill in the gaps for our listener as it relates to the retirement gap.
Absolutely. And thank you, Trev. That retirement gap that you're speaking of really is the difference between what you have and what you want for retirement. And if we look at what most retirement plans are with business owners, most every company has some type of a 401k or some type of a defined contribution plan that allows you to put money aside on a percentage of salary basis or a dollar amount. The challenge with that is that the business owner, usually that person that is probably the greatest income earner because they're the ones the greatest at risk because they're the ones running the company, they're being treated exactly the same as the clerical person up front are. They're limited by the amount that they can put in, either because the limits that the IRS puts on the amount that you can put in every year, or because their employees aren't putting in enough. And that can retard their ability to put that money in as well. So that's what defined contributions do. And while they're great and they're helping, the better would be to be able to give that business owner the ability to have a greater contribution, subsequently greater money in retirement, but also get a current tax break greater than what they currently enjoy. So it's a different way of allowing your employees to let you leverage what you can do so you can get greater benefits going to that business owner.
Okay. And so when we think about, so it's that gap between that, and you said it really well. Say it again. It's the gap between what they have and what they want. Say it again for me.
Right. It's the difference between the assets you have today and the assets that you're going to want to have.
Okay.
We hope that we can plan for the best. Unfortunately, sometimes what we can do as far as planning is limited by what the plans are. And that's why we're going to talk about defined contributions, which are, I know what I can set aside today. I hope it grows to something, versus a defined benefit plan, whether that's a cash balance or it's a 401k or it's a traditional fund. Doesn't really matter. What it is it's a pool of money that says, I know what I want in retirement. Tell me how much I have to put away today. So it's looking at the same retirement goals, but from different prisms. One on one side, one on the other.
And in your experience, which one helps you overcome the retirement gap? It's a loaded question, right? Like I think I know, or at least I think I know what your answer might be, but which one sort of helps you overcome the retirement gap better, if you will?
Well, instead of using the term retirement gap, let's just back it down and say, would you agree that the more money you have in retirement, the better the pile of money that you have in retirement?
Okay, I mean, I can agree to that.
So a defined contribution is going to let you grow it at a certain percentage. A defined benefit is going to say, I know what that pool of money is that I want. So if you can solve for knowing what you want instead of hoping it grows to something, it's much easier. It's a bigger number. But for those business owners, think about it this way. If you got a clerical person making $16 or $17 an hour versus a business owner, what they can realistically look at just as percentages is that business owner is going to need more to have the same type of lifestyle in retirement. Mm-hmm. Let's give them the ability to have those bigger contributions, those bigger tax deductions, and that bigger pool of money in retirement.
Okay, so then let's help let's help some folks out. Like, give us an example. Like, what do you have? Like, if someone wanted to think about, yes, Troy and Tom, this maybe makes sense to me, but help me understand how this plays out from a number standpoint, or what does it look like? Like, what does an example look like?
Let's first establish different things, because we can do a pension plan, you know, like they would have, you know, at the federal government or the larger employers, but that's really not what we're looking at. The target that we're probably looking at is the under 20 lives with business owners nearing retirement, say 45 to 55. We can do it more, we can do it less. It's going to change that. But if we know that if that's what we're targeting, they're going to have different objectives as to what we're trying to accomplish. What I mean by that is, in a 401k, usually you have like a target fund and, you know, some type of investments in there and some fixed accounts. Okay. Usually you try to get more of a return because that's what you're trying to get in a 401k. In a defined benefit plan, it kind of is the opposite way. It's not necessarily about the growth. It's about the tax savings that you can get, and then that pool of money at retirement. So it may be worthwhile to have a lower interest rate, something a little bit more guaranteed. And that's different ways that we're going to do that. So it's what type of flexibility does that business owner want? Do they want guarantees with large tax deductions, or do they want a return on investment because they like to play the market, which means that they're going to have to put in a little bit less? It's a little more flexible, but you're not going to get as high a tax deduction. So it's wondering what they're trying to accomplish and having a good conversation with them about. But just so happens, Troy, I may have already had a proposal already thought of. In this case, we've got a 7 or 8 person group. We've got 2 owners. It's a landscaping group. So if you don't mind, I'm going to share my screen. And
So you're giving us numbers?
I'm going to show you graphs and charts. We're not going to get too hung up on numbers and stuff. I just want to show you the difference, because we're going to show you some side-by-side comparisons, and we're going to give you a quick conversation as to what is better and why. Ultimately, what we're going to need, either you specifically or us collectively, is a good census of date of birth, date of hire, W-2 income for those. And what we can do at that point is run proposals and start running comparisons.
I only ask because I know my team isn't going to there's no way that they're going to do the podcast with me again and go, you let RMC do like charts and graphs and they didn't have to put anything in a jargon jar. So that's the only reason. So I know what to be able to tell my team.
I told you I have Venmo. We can do this together. So there will be some jargon. I apologize, but I think it will help.
Okay. All right. Well, as long as it's helpful and you still put money in the jar. But go ahead.
So what we have here, and I'll just show this real quickly, is I'm going to skip to the bottom line, and I'm going to show you a census. Here's what the planned census looks like. Fairly small employer. And if you notice, the supervisor's older than the 2 owners. That becomes a challenge when you're looking at defined benefit plans. But it's because they're closer to retirement. So if you're closer to retirement, it's a shorter window. You got to put away more money. But look at the annual compensation. That's the key, because the bigger the disparity between the owners and the employees, the better the plan is going to look. So let's get back to just the graphs and charts. Don't get caught up in this. The first option that we have is just a safe harbor 401k. That's what they're currently doing. This is what it looks like. They're putting money aside for their employees. The owners can put in as much as just under 120, so about 60,000 a piece. The other non-owners, everybody else, they're only putting in 11,700 because there was a match here. Okay, so that's not bad. 91% of the benefit is going to those owners, so that's pretty good. But the owners need a bigger tax deduction. So we're going to move toward, let's take that 401k and use it with another form of defined benefit, that pool of money, a cash balance plan. You can use a percentage of your W-2 to help fund that through the employer. And so that's what we're looking here. This is going to have stocks, bonds, mutual funds that we can use. In this case, we can get 93% going to the business owners, and the contribution more than doubled. It's up to $272,000. But because we put a little bit more away, we also had to put a little bit more away for the non-owners. So we have something going aside for them. And then the most restrictive, but the highest deduction that it's going to give you the most in retirement, because you're putting the most away, is a 412E3. Doesn't matter what it's called. It is a guaranteed, fully insured pension. But look what happens. The owners can't put away nearly as much as a percentage. But look at what they can put aside away in a dollar amount. They can put away almost $315,000 each to those business owners versus the $60,000 they had before, which means that the total contribution was substantially more. And so you're looking at, instead of having a savings, a tax savings of 20 or 30,000, you're looking at a tax savings of upwards of 100 to 150,000. Now, Troy, this is where your team is going to love this. Remember how we talked about having more money in retirement is better? If given a choice, you take the larger pile.
Mm-hmm. Makes sense.
So for the business owner, and this is accumulations for the owners, in a 401k, yeah, they can get to just over $3.5 million or just under 1.8 million each. Going up the gradient and then adding a defined benefit plan, you might be able to get them to just over 2 million apiece. But in the end, if you really want to have the most money and get the largest tax deduction, then you'd move toward a 412E3, a fully insured plan. Because at this point, those business owners can have up to $3.7 million in accumulation. Now, they can take that as an income stream, sure, or they can take it as a lump sum. I know that in defined benefit plans, a lot of times they will say, this is what we will guarantee you on a monthly basis. Mm-hmm. That is really exciting, but it rarely ever happens. Because once you leave that money with the insurance company, you're leaving that money with the insurance company. Just like a lot of times when we leave an employer, we may roll our 401k into an IRA. You have that same flexibility at retirement to move that money in and be more self-directed.
Bottom line, though, Tom, let me just see if I can bottom line it for our folks, is with your 401k, defined contribution plan, let's call it, your, like even the numbers that I'm sure that you talked, there's numbers there that you assume that there's a certain growth rate, but that growth rate is something that one needs to attain in order to end up with, I think, the $1.8 million that you discussed. Is that fair?
Yes. And what happens is in the 412, which is the most restricted, it's guaranteed. By legislation, we're going to do it as a guarantee. But in a 401k or in a cash balance plan where you're dealing with securities, you don't have that guarantee. So if you have a year where you lose money, you actually may be asked to put in more money to make up for the difference.
So on the continuum, there's the defined contribution plan, that is the 401k. There is the then there's that middle, call it middle ground, and that's the cash balance plan that you talked about. I think you said the 2 million in your numbers. That has an investment aspect again, and like you just described, if it falls short, you got to put money in. And if I'm not mistaken, if you do really well, you have to you change your contribution. Like the contribution can fluctuate a little bit with the cash balance plan, correct?
Well, yes. And remember, we're solving for those pools. So if you do really well, next year you can put in less. If you do really poor, next year you're going to have to put in more. Think of a seesaw.
Right.
Okay. Depending on how your interest rates go and how it goes.
And then finally, there is 412(b)(3) fully insured plans. I got to put money in the jar now because you made me say code section. So with the 412(b)(3, that is fully insured, and that sort of takes that fluctuating. Now it's quote unquote more expensive, but it takes that fluctuating contributions out. It takes the uncertainty of what the number is going to end up being out, and that's what you get on that fully insured, like based on guarantees. This is what you're this is the pot of money I'm going to have at the end. Is that fair?
Right. It gives you a guarantee, and that a lot of times works well when you're combining the defined contribution, the 401k, with that, where you've got a whole fund lineup. Because if you know that one side of it is guaranteed, how much more aggressive can you be on the other side because you know it's guaranteed? You can be a little bit riskier because you've got a guarantee on one side.
And do you see combinations? Do you guys work with combinations of some combination of maybe it's a 412(b)(3 and a defined contribution side, or maybe it's a cash balance plan and like a 401k profit sharing plan?
Oh yeah, and if we go back, I believe we're still looking at the screen. Am I still sharing the screen?
You're not sharing right now, and I didn't tell you because you were on the roll, but you didn't share. But that's okay.
No, and that's great. But if you go back to the way that we looked at it, the second one was a combo plan. That's the term that they use when you have more than one plan, like a defined contribution, and maybe even a profit sharing plan with the defined benefit. Those pension plans, when you stack them on top of each other. Mm-hmm. That's what's called a combo plan, because you're combining those. A lot of times they have to be what's called cross-tested to make sure that everything is working in combination with each other. But that's what we do as the actuarial firm, as the third-party administrator.
I never thought I'd hear someone make actuarial sound cool.
Wow.
I'm just kidding. Kidding.
You know. Yeah. We've had this conversation. This is a complete departure, but yeah, I had a ponytail and I flew in the Air Force, and I pole vaulted, and now I can cite IRS codes. When did I lose the cool?
Yeah. Well, there you go. So we're definitely on making IRC code sections cool. So
right.
So let's think about winding this up a little bit, Tom. So you kind of alluded to it already. If someone's out there going, does this fit for me? What if someone said that, what are you telling them?
Let's run it, and we'll do a side-by-side comparison, and we'll find out what is the best plan. The one thing that I definitively know after 4 decades in this industry is I don't know unless I run it. And sometimes you look at it, and what we want to be able to do is to be able to say to that client, that individual who is looking at this, are you better off with this or without it? What is the circumstance that is going to get you to your goals in a way that makes the most sense and is the most efficient from a return standpoint, but also from a tax or a tax deduction standpoint? And that's what these plans can do for you.
Absolutely. All right. Hey, thank you, Tom. I really appreciate you coming back for a second visit. Hopefully this is one of many times that we'll get a chance to talk and educate folks So with that, I want to bring this episode to a conclusion. Again, I'm Troy Branch. Thank you so much for tuning in to Future Focus and Financial Strategies podcast. We look forward to seeing you next time. Have a great day.